record. Now I've used Zoom before, but I'm not used it here in at ANU, so I'm not quite sure how it works as far as getting the recording to you guys. So I'll figure that out. But for the most part, I really wanted to try to use this time to, I can go through the presentation if everybody wants that, but thought maybe I would try to answer some questions and maybe about content or other things about the course that you may want to know. Now, again, this is pretty new. The course was actually just created not too long ago, so there might be some things that I don't quite understand myself, but I will go back and find out for you guys. So really want to take this time to just kind of fill you guys out and make sure we're all on the same page, but also I know accounting can be kind of weird, and I want to try to make sure that we are getting through it successfully. So with that said, if anybody has any struggles, any thoughts, questions about what they like to do today for the session, let me know. And if not, I can go through the presentation, just start going through it. And as you think about things, just jump right in. That's why I really wanted you to have a microphone so you can talk. So I'm okay with you guys leaving it unmuted as long as you don't have, lots of crazy noise in the background. All right. Now I have a Bichon Poodle. You may hear him every once in a while barking. Hopefully he's not too disruptive. All right. So here we are. I hope you can see the view. If you can see the screen here, I'm going to go through chapter 3. I thought maybe this was a good place to just kind of insert myself in the course, start talking more about what you should expect to see in this chapter. So in chapter 3, we're going to get into what I think is probably the heart and soul of entry-level accounting. It's learning double entry. It's the double entry stuff. So these are all I have. I just took the PowerPoint presentation right from the actual course. So this is not anything that you don't already have. And perhaps you've gone through it, or maybe you haven't gone through it, and maybe you understood it, maybe you don't understand it. So I want to take this time to help you understand the material. And so again, as I mentioned, feel free to jump in when you have questions, concerns, you don't understand something. You can also chat if you don't have a microphone, just send something through the chat, and I'll try to keep my eye on that as well as the presentation. All right, so double entry framework for accounting. Basically, we're going to talk about those debits and credits and what do they mean. What's the whole point of the debits and credits? Why do we do it? And how do we do it? So the first thing, I think the best way to talk about is by talking about T accounts. Rachel, I'm not sure if you were saying something, Rachel, because I can't hear you. All right, so T account, what is it? Why do we use it? So I want you to think about a business, and in every business we have, there are accounts. And so we consider the fact that we started a business, and that business, in that business, we have different things that we can have vehicle, we can have, we have bank account cash, we have inventory, the things that we sell. Let's say we make t-shirts and we sell t-shirts, right? So our inventory would be our t-shirts, and perhaps we have a computer, laptop, and we have a phone. We use all these things for business. Each one of these items and each one of these things that we have to do business is what we call assets. We talked about that week 1. An asset is any item that we have in our business that has future value and that we can use to do business with. So if we had a table, if we had chairs, we had furniture, all used for our business, these are all assets because they can be used today and tomorrow to do business. So each one of those assets also represent an account. What do I mean by that? Well, We want to keep track of everything we have. We want to keep track of the value of our phone. And remember, I told you they all have future value. So if my phone has value today, I want to keep track of it, and I want to be able to say, well, how much value does it have a year from now, 6 months from now? Same thing with my car, same thing with my inventory. So I keep accounts for each one of these assets so I can tell you what value they have. Why do I care about the value of my assets? Well, the value of my assets lets me know what am I working with to do business. If I have a phone that has no value, then I probably can't do a lot of business with it. So I use accounts. I use accounts to track the value of my assets. Not only my assets, but I also use accounts to let me know what are my liabilities. How much do I owe other folks? And finally, I keep accounts to help me understand the value of what my company is worth after I've taken out all of the debt. So, and we call that owner's equity. So we talked about this in our discussion in week 1. And so the idea of a T account is the reason why it's such a central part of what we do is the T account helps us keep a running total of the value of all of our accounts. So remember the assets, all of our assets that I have, all of these will be accounts. I'll have a phone account. I'll have a cash account. I will have a t-shirt inventory account. I will have an account for my loans to know how much I owe on loans. I have accounts for what is the value, or how much did I put in as an owner? I call that capital. How much did I put in? I'll have a T account for every one of these items in my business. So the T account is central because it helps us just keep running totals on each one of our accounts. And very simple, you'll see that the T account in this slide, you see that the T account has 2 sides. It has a left side and it has a right side. The left side of the T account is what we call the debit side. The right side of the T account is what we call the credit side. Do not confuse debit with subtraction and credit with addition. That's not the idea. All debit means for us is the left side of the T account, and all credit means for us is the right side of the T account. And we'll understand why that's important a little bit later. But just know that every single one of our accounts in the business could have one of these T accounts, and it will have one of these T accounts. And the whole point of it is to keep track of the value of those accounts. All right. Just a quick check. Want to make sure that everybody can hear me and can see the screen. And if you can send a chat just to let me know you can hear me.
I can hear you.
Good, good. Just want to make sure it's kind of
I'm just
silent.
so you don't hear my dogs barking.
Okay, that's fine. All right. All right. So we talked a little bit about that T account. And again, as I mentioned, left side, the debit means left side. That's all it means. It doesn't mean minus or subtract. It just means left side. And the credit means the right side of the T account. We want to make sure we keep that in mind. So when you see the word debit, don't think about, oh, I have to subtract. That's not what it means. It just means the left side of my T account. And again, that T account will represent I have a T account for every type of item that I have in my business that I want to keep track of. All right. When we see DR in our homework or in the textbook, DR is just abbreviation for debit, left side of the T account. CR is just a short abbreviation for credit, right side of the T account. Now here, as I mentioned before, right, we'll have an account. In this case, we have a cash account, right? And what is this T account going to do? This T account is going to be able to tell us at any moment in time what is the balance of this cash account. In other words, how much cash do we have on hand? So using this T account, we should be able to look at it at a glance to be able to say, hey, this is how much cash we have. This is the value of our cash account. Remember, this T account could be any item that we have in our business that we want to keep track of. In this case, we're using the cash account. All right, so let's see. So every T account has an increase side and a decrease side. Now that's important. For right now, let's just know that one of these sides of the T account, we'll use it when we're increasing something. So if we get more cash, one of these sides of the T account will show when cash is increasing. The other side of the T account was going to show when that item is decreasing. Now, is it always the same side for every account? It is not. And that's why I wanted to make sure that you understand left side doesn't always, or credit doesn't always mean add, and debit doesn't always mean subtract. Debit, again, just means the left side of the T account. Credit means right side of the T account. All right?
Oh, dang. That's dripping. I don't want this. You're old. Yes.
All right. Are you guys able to hear me? Can you guys hear me?
watch it because I don't have a textbook.
Hello. How about now? Can you hear me now? I can hear you guys pretty good. I'm just wondering why you can't hear me. Can you guys hear me now? Can anyone, if you can hear me, chat, say yes?
Yes.
No. You can't hear me. Who's that?
Me, Teresa.
Teresa, you can hear me. Okay. Shannon, can you hear me?
Yes.
And Raquel, can you hear me? Not sure. Let's see. All right. Let's see. I think some folks can hear me and some cannot. So Raquel, I'm not sure. All right. Okay, one more time. Teresa, you can hear me?
Yes.
Shannon, you can hear me?
Yes.
I'm not quite sure. I see a number 901-630. I don't know if you can hear me or not.
Yes.
Good. And then is it Sadie or I'm not sure if it's Saidi. S-A-I-D-I. Can you hear me? All right, so let's hopefully we can the recording we can grab that. All right, so I want to go back to the T account. So again, with the T account, left side debit, it just means the left side of the T account. That's all debit means. Right side credit, it just means the right side of the T account. When we foot these accounts, all we do is we add up the left side, get a total number, add up the right side, get a total number, take the difference between the two, and whichever side is larger is the balance. So in this case, we have a $370 debit balance in our cash account. That means we have $370 in our cash account. All right. So now let's talk a little bit more about these debits and credits. So to debit an account means, again, to put it on the left side of the T account. And the credit means to put it on the right side of the T account. For asset accounts, a debit will increase the account. For an asset account, a credit will decrease that asset account. All right. Okay, so now here we have this picture. Is everybody able to see this on the screen? Everybody can see the picture here?
Yes.
Assets, liabilities, owners, equity. And let's talk a little bit about what that means. I want you to focus on the equal sign. All right. We all know that this is you probably read this. This is our accounting equation. You guys familiar with the accounting equation? Assets equals liabilities plus owner's equity. Okay, owner's equity. Now here's one thing that I did to help me remember how this thing works. I pay attention to the equal sign. So anything on the left side of the equal sign, which is just the assets, anything on the left side of the equal sign in the accounting equation, if I put something on the left side of the T account, it'll increase it. Anything on the right side of the T account, if I put it on the right side of the equal sign, if I put it on the right side of the T account, it will increase it. Notice here they have plus sign on the left side of the T account because it's on the left side of the equal sign. Notice here, liabilities, owner's equity on the right side of the equal sign. To increase it, you put it on the right side of their T accounts. So if I had a liability and I wanted to increase it, I would put it on the right side of the T account, whatever that T account is, loans payable, accounts payable, mortgage payable, etc. If I had an owner's equity account, for instance, like capital, if I wanted to increase it, I would put the amount on the right side of the T account, or in other words, I would credit it. All right. So again, as I mentioned before, don't think of debit as subtract and credit as plus. That's not what it means. Debit just means left side of the T account. Credit means right side of the T account. So as we go through more of our examples, we'll get a chance to see that. Now they've got this umbrella thing here. Why are they doing that? Because underneath owner's equity, we have a bunch of accounts. We have different kinds. We have things like capital, right? And we saw that last week. And I asked you guys, can you give me at least three types of asset accounts, three types of liability accounts, and three types of owner's equity accounts. We also have underneath owner's equity expenses and revenues in drawing. Well, what are these things? Well, an expense, and I want to make sure you understand this, because an expense is not the same as a liability. They may seem to be the same, but they're not, and I'll tell you why. A liability is something that we got a benefit from, but we still owe on it. So if I got something that, for instance, if you got a car, but you still owe on the car, well, the car is not the liability. The fact that you have to pay back money is the liability. So for instance, if you got a car that's worth $20,000 and you borrow $15,000 and you still have to pay $15,000, well, you owe $15,000. That's your liability. Okay, so a liability is something that you still owe. You got something and you still owe for it. An expense is different. An expense is the use of some asset or the future use of an asset doing business. Now, how's that different from liabilities? Because with an expense, well, if you pay the expense, you don't owe it, do you? For instance, if you have a utility bill and you pay the utility bill, well, the utility bill was an expense. Do you still owe it? No, you paid it, right? So I want you to understand that an expense is the use of an asset or the future use of an asset to do business activity. All right. So if, for instance, if we have a t-shirt company, if we buy t-shirts, right, that's an expense because it's related to doing business. On the other side of that is our revenues. Well, revenues, I want you to understand, is the inflow of resources related to business activity. So again, if I sell a t-shirt, that's a revenue. Why? Because the income that I get from selling that t-shirt is related to me selling t-shirts. Now, if I took out a loan and I got money in the business for doing a loan, would that be considered revenue? Anybody, what do you think? If I got cash in my hand because I took out a loan, would I consider that as revenue? You can chat your answer if you think that's revenue or not. Any takers? Anybody? If I took out a loan and I got cash from the bank from taking out a loan, would that be considered as revenue? What do you think? Anybody? Okay, I have one student that says, I don't think so. And why would you say that? So, yeah, and I
It
guess
shouldn't be classified as a revenue.
No, it shouldn't. And the reason why ultimately is because it has nothing to do with selling t-shirts.
Mm,
So if let's say I got cash, let's say a friend walked up to me and said, "Hey, I'm going to give you cash for your business." Would that be considered revenue?
Yes.
Now remember that revenues has to do with selling t-shirts. Did I sell a t-shirt to my friend?
no.
No.
So would that be considered revenue?
No.
No, that would actually be what we would call owner's equity, but it would go into our capital account. Revenues purely have to do with selling business items. Okay. So in that case, the loan would actually be a liability. Although we got cash, as you pointed out, Teresa, we have to pay it back. So that's a liability.
Repayment obligation.
Absolutely. When my friend gave me money for the business, I didn't give him t-shirts in exchange for that. So that's not revenue. It's not related to my core business. That would actually go into capital. Revenue, we should understand, is purely dealing with transactions related to my core business. All right. So revenues and expenses, they work together in that I have revenues from doing business and I have expenses from doing business. All right. Now, drawing, what is drawing? Drawing is simply this. This is something I take out of the business, but it has nothing to do with doing business. Again, I sell t-shirts, but let's say I take out $500 to buy tickets to the Cleveland Cavaliers. I'm a Clevelander. I take out tickets to buy money to buy tickets for the Cavaliers. Does that have anything to do with selling t-shirts? No. So I wouldn't call that an expense. I would call that drawing. Anytime I take out of the business for personal, as the owner, I call that drawing. All right. So all these accounts, I want you to notice here on the left side of the T account for assets is an increase. Why? Because it's on the left side of the equal sign. For liabilities, when I want to increase it, I put it on the right side. Why? Because it's on the right side of the equal sign. Same thing for owner's equity. The only account that does not behave like that, or the only two, is expenses and drawings. Notice that if I want to increase an expense, I put that on the left side of the T account. And if I want to increase the drawing, I put that on the left side of the T account. But everything else on this side of the equal sign, right, it increases when I put it on the right side of the T account. All right. So let's see if we can take a look at a few more transactions. All right. Asset accounts, as I mentioned, they increase when you put the amount on the left side of the T account, it increases it. So if I got $5,000 in cash, I would put that $5,000 on the left side of the T account, or I would debit it. I would call that a debit. If I spent $5,000, I will put that $5,000 I spent on the right side of the T account, or I would say I would credit my cash account. Does that make sense? All right. Now for liability accounts, as I mentioned earlier, and again, I like to think of it this way. Liability accounts are on the right side of the equal sign. So when I want to increase them, I do it on the right side of the T account. So for instance, think of it this way, liabilities. This is tricky for some students, but think of it this way. With liabilities, as my bills increase, the liability account increases. So think of it like this. As I get more stacks of paper, so I have more bills, that liability account is increasing. However, as I pay those bills off, that liability account is decreasing. So when I get more bills, I put that amount on the right side of my liability account. When I pay bills off, I do that on the left side because the bills are going down. Okay? Any questions on that? Capital account, same way. When my capital increases, or for instance, in our this week in our discussion question, one of the first things I asked you in those 4 transactions is the capital account. You get a $10,000. Somebody puts $10,000 into the business. Well, that's an increase of the capital account. And so that amount will go on the right side, right, of my capital account. But for some reason, if I took out some money of my capital account, I would put that on the left side of my T account. Why? Because a decrease in my capital account goes on the left side, and an increase of my capital account goes on the right side. Expense accounts. Remember this. You can write this down. This is sure as gold. All expenses are debits only. You will not see a credit for an expense. Expenses are always debits, period. Drawing accounts, same thing, always debits. And revenue accounts, and I don't think they have a revenue account, but a revenue account will always be a credit. All right, so they have here a chart for you to use if you want to try to, what I mentioned earlier doesn't help, you can use this to kind of guide you. But again, I just like to use the equal sign to help guide me on to figure out where is it a debit or a credit. But you can use this again when we say normal balances. For instance, your cash account it should always be a debit balance. Right? That lets me know it's positive. If it's a credit balance, that means you have an overdraw on your account, which is not a good thing, right? So normal, what we mean by normal balances, this is what it should be if it still has value, right? These are the normal balances for those accounts. All right, I want to try to go through some transactions here, and I want you to walk me through them. I want you to tell me what should happen here before I give away the answer, all right? So we have a transaction here. What happened here in this transaction? Rohan Maxon, the owner, invested $2,000 in the business. So what actually happened in this transaction? Well, the owner, right, put money into the business. Remember, the owner and the business are two separate entities. So if I, as an individual, have $2,000 in my personal bank account, I take that money out and I put it into the bank, to the bank account of the business, that $2,000 no longer belongs to me. It belongs to the business. But in exchange for me putting $2,000 into the company's bank account, I get $2,000 of ownership. Or in other words, I create a capital account when I put money into the business. So what happened here? Two accounts were affected by this transaction. The cash account for the business and a capital account. That's right. I think I heard somebody say debit, right?
Debit.
Absolutely.
2,000 in debit. Capital account is sitting at credit plus 2,000.
Absolutely. Absolutely. That's right. That's exactly right. There you have it. So remember, with every transaction, any transaction we do in a business, at a minimum, at least two accounts are affected. At least two. It could be more, but it will never be less than two accounts affected by a transaction. All right. So here's what happened here in this case. And Raquel pointed it out. We're going to have a debit, 2,000 in cash, right? And we're going to have a credit, 2,000 in cash in the capital account. And there it is. Our journal entries, every time we do a transaction, the debits should always equal the credits. Okay? Debits should always equal the credits. There should never be a case when one is more than the other. If that happened in your transaction, something's wrong. Right? Our debits and our credits should always be equal. All right, here's another transaction. Purchased a motor scooter for $1,200 cash. Let's talk about what are the two accounts that got affected before we talk about debits and credits. Let's talk about, somebody tell me, what are the two accounts that were affected by this transaction?
Cash credit. Of course, cash is going to go down minus 1,200 in credit.
And what will be the other? We have to have two accounts that are affected here.
purchase. You say that accounts payable drawings. Would it affect the drawings or the capital?
Well, let's think. What is a drawing? Remember, drawings for something. What? When you do a drawing, it's what? It's personal, right?
It is personal, so it's no. It doesn't affect the drawings. It's expenses.
So let's think about it. Let's back away. Let's take our accountant hats off, and let's just think what happened here in this transaction. What happened?
Decrease credit. Would it be expenses? Credit the expenses?
Well, let's back away from that.
Uh-oh.
Let's just talk about what actually happened. What did we do in this transaction?
Purchase a motor scooter.
Yeah, we purchased a motor scooter. So what did we get?
The motor scooter.
We got a motor scooter, right? So guess what? We have to create a new account. What would that new account be called?
Would it be the owner's?
No. What did you get?
The motor scooter.
Yeah. So what would the account be called?
Motor scooter.
Yeah. So we would
It's an
have.
asset. It was supposed to sit under assets, so
Yeah,
it's a
so-
new T ledger.
So we have a new account. We got something. What do we get? We got a motor scooter. So you don't just walk around giving away $1,200 in cash like, oh, I just gave away $200 in cash. That's just the way it is. No. Anytime you do a transaction, you're getting something and giving something, right? In this case, we got a motor scooter. In order to get that motor scooter, we had to give up $1,200 in cash, right? So how would that transaction look? As far as now we can talk about debits and credits. What would our debits and credits be now? We know we have-
cash would be the credit and the delivery equipment would be the debit
Yes. Why would the delivery equipment be the debit?
because you're increasing the equipment.
That's
It's an
exactly
asset.
right. That's right. What happened to the cash?
You decreased it. It went away.
Absolutely. So there it is. Okay. Does that make sense, everybody? Your delivery equipment went up because now you have a new asset. And in order to get that asset, your cash had to go down. All right. And again, debits equal credits. All right, here's another transaction. Purchased a second scooter on account for $900. Now, what happened here? Let's talk about what did we get? What did we give up?
You got the motor scooter
Mm-hmm.
and you lost $900.
In this, so we say we
But you're
got.
still owing, right?
We owe it. Now, did we give up Did we give up $900 in cash in this example?
No, you're still owing it.
You owe what?
The motor.
Well,
Scooter.
we did get the scooter, right?
Mm-hmm.
So think about it. You went somewhere. You said, "Hey, I need a motor scooter, but I don't have money," right? So
Yeah.
when that happens, what do? You get the motor scooter, but in exchange for what?
For a loan or something?
Yeah, a bill. And so what happens to your bills?
You have to pay them off.
So in this case, did they go up or go down?
It went up.
So when your bills go up, what side of the T account?
That's a Is that a credit?
Yes, exactly. It is a credit. And what about the debit? What would the debit be here?
The motor scooter?
Absolutely.
Yeah.
That's it. So let's take a look at it. Right? The motor scooter equipment. We got more motor scooter equipment, right? So that went up. And our bills went up, right? Our bills went up. Right. So again, remember when our liabilities increase, we put those on the right side, or we credit those. Does that make sense to everybody?
Yes.
Any questions on that one? I know that was a little tougher, but any questions on that? All right. Good. Okay, here's another transaction. Rohan made deliveries and received $500 in cash. So before we talk about debits and credits, let's think about what actually happened. What did we get? What did we give up?
He gave the deliveries and he got 500 in cash.
Ah, okay. So we got cash and we gave up deliveries. So what is that?
So the cash would be the asset,
Uh-huh.
and
And what
the delivery would, I mean, the cash would be the debit and the delivery would be the credit.
delivery? And so that delivery is what for us?
Um,
So let's think about it. Remember, we're in business, right? We are in business. What does that delivery represent for us? What does that delivery represent for us? What do you think?
would that represent like the owner's equity?
Why would it be owner's equity? Why did we receive $500 cash? Did they give us $500 cash because they like us, we're pretty, we're handsome?
No, you gave something in exchange for the money.
And why did you give it? Because what?
They paid for it
They paid for it? And why did they pay for it?
because they needed it.
They needed it, of course. And why did you give it to them?
Because that's what the business is.
Absolutely. And so if we do a transaction based on our business, what do we call that? Remember the word we use for that? We had two words, right? In the owner's equity account.
Revenue.
Absolutely.
Revenue?
Yes, that's it. There you go. Revenue. That's what we do for a business. So we got $500 because we did business. All right. So our fees, our revenues, remember I told you, revenues are always what? They're always credits.
Credit.
Absolutely. So if the revenue is the credit, the cash must absolutely be the what?
The debit.
Absolutely. So let's take a look at that. Here it is. Cash went up. Our revenues went up. Make sense? Any questions on this? No? All right. Okay, so here's another one. All right. A little tricky, but Rohan made deliveries on account for $600. Now, what did we get here and what did we give up?
They gave the deliveries and you gained 600 in credit in account.
Oh, so did we get cash this time?
No.
No. So what happened here? What kind of sale was this? Because it was a sale. It wasn't a cash sale. It was what kind of sale?
Loan, was it the loan?
Well, would it be? It wouldn't be a loan for us, right? Because we didn't borrow anything. So this would be. We would call this an account, a sale on account. All right. We would call this a sale on account. Now here's the thing. We did not get cash for this. Is it still a sale for us?
Yes.
So would this still be revenues?
Yes.
Yeah, but we didn't get cash. So how do we account for that since we didn't get cash?
Marvin.
What's that? How will we record the fact that we made a sale?
They're still paying back. So it would still be a debit.
To what though?
What was the word you said a while ago?
Revenue.
Well, yeah, revenue would be our credit, right? Because that's
But
no
the account.
account.
The account. What was the word? The account on business or the account on payable?
Account revenue or account receivable? Is that what you mean?
Account receivable.
There you go.
Be
That's
the
it.
debit?
Yes. Accounts receivable is when somebody owes you for business. All right. So you made a credit sale. All right. You look, you still have your revenues. They still owe you. I like to think of the accounts receivable as a sticky note for me to remind me that somebody owes me money. All right. And so here, my accounts receivable, anytime I do a sale and I don't get cash for it, I call that an accounts receivable. That makes sense? So think of it this way. Anytime you do a sale, it's either going to be cash or accounts receivable. Either one you do, there'll be a debit in that account. Okay. If it were a cash sale, it would debit the cash. If it's a sale on account or a credit sale, we would debit accounts receivable. They are both assets. All right.
Mhm.
These are both assets. Any questions on that? Okay. All right. Let's do a couple more and then we'll call it a night. So Rohan paid his part-time employees $650 in wages. Before we talk about debits and credits, let's think about what we got and what we gave up. What did the business get in this
You got
transaction?
the employees, the
Got the-
workers,
We got work out of the employees, right?
and he gave 650.
All right. So in that case, what two accounts are affected here?
Would it be the expenses?
What kind of expense?
Wage.
Yeah. Why will we call this an expense?
Because it's something that the business is.
Absolutely. It's related to business activity. You got it. All right. So what would be our debit and our credit? Remember what I said about expenses? They are always what?
Credit? I mean, credit?
The other side.
Debit?
Yeah. Expenses are always debits. That is a hard, fast rule that will never change. All right. Expenses are always debits. So in this case, we have an expense account called wage expense, and we have an asset account that's affected by this transaction. The debit will go to the expense account. The credit will go to the cash account. Why? Cash went down.
Okay.
Expenses went up. Make sense?
Yes.
All right. Questions on that transaction, anyone? No? All right. All right, here's another one. Rohan withdrew $150 in cash for personal use. Keyword, personal use. What would this be? Well, again, before we talk about debits and credits, which two accounts were affected here?
Cash and capital. Drawings.
Drawings. There you got it. Pretty good. Cash in drawings. Right? Remember, drawing is for what? Personal. Right? What's the debit? What's the credit?
The debit. The credit is the
Drawings.
the drawing, and the no. Would it be the withdrawal? Would be the debit?
Okay.
And
So what happened to cash here?
it was taking away from the business.
So what happened to the cash amount? Did it go up or down?
It went down.
And when cash goes down, what side of the T account?
Credit.
Credit. Ah.
So the with the drawings, it would be credit.
So remember, cash went down, right?
Mm-hmm.
So if cash goes down, it would be a what?
A credit.
And the other account must be?
Debit.
Yeah.
Debit.
So the drawing is debited. Cash is credited. Okay? There it is.
Okay, question.
Yes.
Do we always have to like label each side?
When you say label, what do you mean?
Like right here where we have on the screen that it says drawings,
Hmm.
and then the other one has cash.
Yes. So we should always, our T account should always have a name, right?
But it has to be based on the formula, right? Where we were looking at the umbrella earlier.
Well, let's put it this way. Anytime we have a transaction, we know two accounts are affected, right?
Mm-hmm.
So we always have to have those two accounts represented. All right.
But it's like the name of the account doesn't matter.
Yeah, absolutely does matter, because remember, each one of these accounts we want to be able to look at it and say, well, how much is left in my cash account? So every time I do a transaction, right now they're just showing you one at a time, but really we should have a bunch of stuff here for every cash transaction we've done.
Mm-hmm.
So anytime I do a cash transaction, I go back to the same T account, and either I'll put it on the left side or I'll put it on the right side. All right, so the name of the account is critical. It's important. Can't leave that out.
Okay.
And we'd probably have like hundreds of these T accounts all over the place. Remember, we have a scooter account, right? We have drawing account. We have a wage expense account. We should have about, at this point, we have about, I think about 6 or 7 accounts out there, right? All based on these transactions we've done. All right, let's see. Trial balance. What is a trial balance? So what we'll do now, I want you guys to take a look at this. What do you see here in this column here? All the debit transactions. So what we did in the previous slides, we would add all those things up. All the amounts that were on the left side of the account, we put them on the debit side. So in this case, we had 3,600 in delivery equipment. Remember, we had one for 900, and I think we had another one for what, 1,800 or something like that. Not 1,800, was it?
It was like one something.
Okay, had to be that. So the total of that will give us a total debit in the T account of 3,600. So everything, we take all these accounts, we look at them and find out, we do the footing on them, and whichever accounts had debit balances, we put on the left side in the debit column. And then everything, that's credit balances, we put it on the right side. Now, what should happen in our trial balance is that the debits should equal the credits. That's why we call it a trial balance. Now, what does this tell us? It tells me that I should have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. I should have 12 T accounts out there, because each one of these represents a T account where I was keeping track of everything. Remember, I told you I use those T accounts to keep a running balance. So I should be able to go to all my T accounts and put their balance. If when I did my footing, the answer was on the left side, I put the answer here. When I did my footing, if my answer was on the right side, I put it over here. Once I put all these, put all these accounts on here, every single one of my accounts should go on here. I'll add them all up, and they should be equal. If they're not, I made a mistake somewhere. That's why we call it a trial balance. It's a trial because we're trying to find out, is everything equal? It's balanced because both these numbers, the debits and the credits, should equal each other when I add them up. So let's see what happens here. They balance in this case. The left side, all my debits, 5,950. All my credits, 5,950. All right. I'm going to pause right there, only because I think we went through a lot of stuff. Any questions on what we've talked about so far? Any thoughts about homework from the previous, from week 1, or homework that you're looking at this week?
I have a question.
Yep.
You know how the discussion, I was confused on the discussion. When we're doing the T chart, let's say we have like cash and like Maybe delivery. We only put like the cash on one T chart and the other on the other T chart, or does
What?
the T chart have to have like both?
Okay, so you're talking about the actual discussion for this week?
Yes, because I was confused.
Let me see if I can pull it up real quick. Okay, give me a second. And I want to make sure that we're on the same page here. And let's look at it.
Can you all hear me?
Yes,
Yes.
I can hear you. Let's see. Okay, can you guys see the screen?
Yes.
Okay, so Teresa, you had mentioned, all right, so here are transactions. And I want to make sure I understood what your question was.
Okay, hold on. Stop right there. Go back to the top. Like right here on the transaction 2.
Okay.
Are we gonna have like one number on one side and on the other one on both sides, or just on one?
Well, here's the question. Well, that's a good question based on what we talked about. Remember, what does the T account do? It gives us a running balance. I want to be able to look at this T account and know how much cash do I have. I know that I've spent cash, I got in cash, and this T account's going to tell me what's left. So remember, one side adds or increases it, another side decreases it. So we have to have something happening on both sides. If we're bringing it in and putting it out. So in this case, let's take a look. Our first transaction says what?
10,000 starting capital.
Did it come in or go out?
It came in.
Cash came in. So what side of the T account should it go on?
Left.
Left.
All right. Now, what happens in our second transaction?
We spent 1,000.
So if we spend 1,000, do we put it on the left side to say we got more?
No, you put it on the right side.
Then that means I subtracted. So now my balance is how much?
9.
9,000, right? So that's the point or purpose of using T accounts, because we can quickly see how much our balance is.
So we don't have to create another T chart to
No.
show. Okay.
No. Yeah, for cash, we have one account because we want to get a running balance. So then what happens now? So let's look at the next one. What happens here? It says something else happened here.
Oh.
Transaction 3.
Go up.
Borrow 5,000.
Yeah, we just did the adding here.
That's
Yeah, we just added.
Okay.
Yep. So what happens in transaction 3?
We borrowed 5,000, so that increased the left side.
Yeah, so it should go on the left side, right?
Correct.
Okay, so why does it still have the 10,000 there?
Because remember,
Shouldn't we have like the 9,000 and then add 5?
no, see what I'm showing you here is just you're footing as you go along, but typically you wouldn't foot as you go along. I just want you to see how that works. So that 9,000 is just saying the difference between the two. Now that I have another transaction, I don't have to foot all over again. I got to add these, subtract that, right?
Correct.
So that means that's 15,000 came in, right? We got $10,000 from the owners, and we borrowed 5,000. We have a total that came in of how much?
15.
And a total of how much that went out?
2,000. No,
In this case, how much? Just one.
1,000.
Yeah, 1,000 went out, 15,000 came in. How much should be in our account?
14,000.
14,000 because we spent 1,000.
Absolutely. So that's all this is showing. 10,000 from the first transaction, 5,000 from the second transaction. The total of those, there should be a line here, but I can't draw a line in this discussion board, so I apologize.
Okay, I get it.
That's what's freaking you out. There should be a line right there that says, okay, the total is that and the total is that. The difference between the two is 14,000. Okay?
Okay, I have a question.
Yes.
So, do we have to leave everything on the left? Or
When you say you have to leave it, what do you mean?
So say for instance, okay, we had the 10,000
Mm-hmm.
and we spent 1,000.
Uh-huh.
So do we have to leave the 10,000 or can we just put 9,000
No,
on it?
if you put 9,000, again, because remember what we do is we add these all up.
Okay.
So if you put
I got you.
9,000 there, right?
Right.
You want to show what came in, what went out.
Okay.
Right? And so we
Okay.
leave them as they are.
We leave everything.
Every transaction you leave it.
All right.
Because
Okay.
what we'll have to do, we may have to go back and say, if this thing doesn't add up right, well, what happened in this first transaction? How much was the first transaction for?
Right. Okay.
Because remember, there's another T account out there with 10,000 on the right side.
Mm-hmm. Capital.
Yep.
Right. Because we owe it.
No,
correct.
right here. So these things have to balance each other. If I put
Okay.
9,000, they won't balance anymore, right?
Okay.
So
Okay.
in order,
I get
there's a 10,000 on the right side over here, and then there's a 10,000 on the left side over here. With this 5,000, there should be a 5,000 on the left side of cash, but then there should be 5,000 on the right side of another account, right?
Loan
Correct.
payable.
Right there. There it is. They should always be matching. Every transaction I do. And transaction 3 or 4, I should say. What happened there? We did what? We paid down the loan. Here's my 2,000.
Yeah, you pay 2,000 back and that left 3,000, but it's on the right side because it's still owed, correct?
Right. But then I also have to have a matching 2,000 somewhere else.
Loan payable.
Loan payable. Right there. So every time I do a transaction, that's why I asked you guys to do your transactions, right? Because I want you to see that every time I do something, it's going to affect at least 2 accounts, and they should always balance. So if I got something, 2,000 over here, I should have it on the left side of some other account somewhere else.
Okay.
That should always happen. Okay. And so going back to that trial balance, if I do this correctly, I'll take. So this has a $12,000 balance right now. This has a $3,000 balance right now. This has a $10,000 balance right now. I should be able to go, and this one has a $5,000 balance. I should be able to take all the stuff on the right side and all the stuff on the left side. They should be equal when it's all
12,000.
done. Do they add up? Yeah, they should. If they don't, I did something wrong. Okay.
You did. You know you did.
You're probably right. My wife says it all the time. Okay. All right. Okay. So, that I want you guys to feel free to reach out. I believe my phone number is in the course, in the introductions. So you can, I don't really, text. I'm not really good at text. I'm old in the mind. So it's probably better if you send emails. If you send emails, I respond quicker to those than I do with text. Sometimes I don't know who the text is coming from. So if you have questions, you can send me an email and say, hey, can you look at, I'm stuck on problem 5. I don't know what to do with that. Can you help me out with that? I'm more than willing to help. I'm thinking about maybe trying to do something like this again. I don't know if next week is good. It looks like, typically when I do these, nobody shows up. So to have 4 people or actually 6 people, that's great. So I don't mind doing this again. If you guys want to try to do it again, same bad time, same bad place.
So next Wednesday,
Yep.
7 o'clock.
Yep, that works.
That's fine.
Okay. Will you send us an email just to make sure?
Yeah, I'll do it the same way I did last time. If something comes up, I'll let you guys know. But otherwise, we should plan to do it the same way.
Thank you.
Okay.
Mhm.
All right. You guys have a great night. And this was recorded. Hopefully,
Oh my God.
I can get the recording out. Okay.
Mhm.
All right. Take care. Have a great night.
Okay.
You too. Thank you.
You too.
You as well. Bye, guys.
Bye bye.
Bye. Your daughter's absolutely adorable, by the way.
She is.
Thank you.